All right, let's dive right in. We're going to tackle a huge question today. How in the world do you navigate a crypto market that's flashing all sorts of warning signs? We're going to break down a really clear strategic framework that'll help you make sense of all this chaos.
The single most important feeling driving the market right now can be summed up in two words: extreme fear. The fear and greed index is basically parked in that zone. And look, this isn't just some number on a chart. It's the collective psychology of everyone in the market, and it really sets the stage for everything we're about to talk about.
And this fear, it has consequences. It's causing this classic market rotation where money is literally flowing out of riskier things like crypto and into traditional safe havens like gold. People are just looking for stability, and that big shift is putting intense selling pressure on crypto.
And that pressure is absolutely real. We've actually seen Bitcoin, which is kind of the bellwether for the whole crypto market, slip below a super crucial support level, which the source material puts at around $88,000. When a break like that happens, it's a major signal that gets everyone's attention.
So you have to understand, this isn't just another dip. It's a real decision point. This kind of market forces you to make a choice, and it really separates two very, very different mindsets for how to move forward. So let's start with path number one, the trader's playbook. You should think of this as a tactical sprint. It's all about speed, it's about precision, and it's about cashing in on those short-term moves. For a trader, the world moves incredibly fast. They're watching chart patterns develop over just a few days, trying to profit from volatility over a couple of weeks, and they have a laser focus on huge market-moving events, like, for example, the upcoming FOMC rate decision on January 28th. Their game plan it boils down to three key moves. First, you spot the opportunities. If the market keeps falling, those are your bearish plays. Second, you got to have a plan ready for any potential bounces. Those are the rebound plays. And third, and this is the most important one, everything is built on managing your risk with extreme discipline.
So let's get specific. For Bitcoin, a trader might be looking to set up a short position if the price cleanly breaks below that $87,000 support level. For Solana, the setup might be a short if it tries to go up but fails to get back above that critical $125 to $130 resistance area.
But hey, good traders don't just bet on things going down, right? They play both sides. So for a rebound, they're not necessarily looking for a whole new bull market. Not yet. Instead, they're just looking to trade the bounce inside a pretty well-defined channel. For Bitcoin, that could be between, say, 86,000 on the bottom and 90,000 on the top. It's a similar idea for Solana, playing that range between about 118 and 130.
Okay, deep breath. We're about to do a complete 180. Let's move to the second path, the investor's horizon. If trading was a sprint, this is a strategic marathon. The entire mindset, the whole philosophy just completely changes. And you can see the difference right away. Just look at the timeline. We're not talking about days or weeks anymore. We're talking about a horizon of 6, 12, even 36 months or more. The goal here isn't to catch a quick bounce. It's to slowly build a position based on a long-term belief in what you're buying.
Now, the number one tool in the long-term investor's toolkit, especially in a market like this, is something called dollar cost averaging, or DCA. It's such a powerful strategy. Instead of trying to be a hero and perfectly time the absolute bottom, which is basically impossible, you just invest a fixed amount of money on a regular schedule. This whole approach smooths out your average price over time and seriously reduces the risk of accidentally buying everything at a temporary top. Within an investor's portfolio, different assets play different roles. Think of it this way. Bitcoin is often like your anchor. It's the core position, the digital gold with that strong institutional demand and the whole store of value story. Solana, on the other hand, that's your growth play. It's a higher beta asset, which is just a fancy way of saying it's more volatile, but it gives you exposure to the world of smart contracts and, potentially higher returns. So if you're a long-term investor, you look at Bitcoin's price swings and you don't panic. In fact, you might see an opportunity. The long-term thesis that big institutions will keep coming in and its store of value narrative will get stronger, that's all still intact. So the strategy is to actually use these dips to build up your core position at better prices. Now with Solana, the strategy has to be a little different, and that's because it's a riskier bet. The long-term idea is built on its potential for growth and yield, but the key word here is incrementally. You don't just go all in at once, no way. Instead, you might buy in stages, especially when the price gets near major support levels like that $110 to $120. Okay, so we've got these two totally different approaches, right? The sprint and the marathon. But here's the really cool part.
Underneath both of them are a set of principles, a set of rules that every single person in the market, whether you're a trader or an investor, should probably follow to survive.
Let's call it the universal rulebook. First, diversify with some assets that are less volatile, like Bitcoin or even stablecoins, so you don't have all your eggs in one high-risk basket. Second, rebalance your portfolio once in a while to lock in some profits and manage your exposure. And finally, if you're using any leverage at all, you must have strict risk controls. Seriously, in this market, volatility is no joke.
Okay, let's bring it all home. We've talked theory, we've talked paths, we've talked rules. So what do you actually do? It's time to translate all this strategy into real action.
This is the question you've got to ask yourself right now. Knowing everything we just covered, what does it actually mean for your portfolio? How do you take these ideas and actually build a position that makes sense for you?
Well, it really breaks down into 3 types of players. See which one sounds like you. The conservative type is focused on long-term accumulation of Bitcoin on the dips, maybe keeping Solana as just a small, strategic piece of their portfolio. The moderate investor is using that DCA strategy for both, layering into positions during pullbacks. And the aggressive player, they're playing that short-term game we talked about, swing trading the range and using super tight risk controls.
And that brings us to the final, really big question I want to leave you with. When the market is screaming extreme fear, the easy thing to do is absolutely nothing. But the real question is, what's the greater risk in the long run? Making a strategic move based on your plan, or being paralyzed by fear and doing nothing at all? Something to think about.